Hello everyone! As we do every month, we are going to share with you the main insights that can be extracted from our digital top-down methodology. Our method consists of evaluating the attractiveness of European equities with regards to 4 complementary pillars of analysis. The first pillar focuses on the economic momentum in Europe. After reaching an all-time high at the end of June, it is decelerating but remains at a high level. The favorable base effects linked to the summer of 2020 are dissipating. However, the economic recovery will be strong, with the consensus of economists expecting 5% GDP growth in 2021 and 4.3% in 2022 in the Eurozone, although the arrival of the Omicron variant could cause revisions on the downside. It is worth noting that the equity market has logically moved in tandem with the economic momentum by falling in November. The second pillar deals with the monetary policy implemented by the ECB. The latter is very accommodating, and the spectacular rise in inflation is bringing down real rates and is facilitating the diffusion of a monetary policy that will be remained in 2022, according to the comments made by Mrs. Lagarde in November. The new health worries and the probable easing of inflation in the coming months will be put forward to justify the maintaining of the accommodation in 2022. Monetary conditions are not without consequences for the third pillar of our analysis, which covers the valuations of the European market. In a context where the interest rates are very low or even negative, the notion of valuation becomes key. The risk premium of the European equity market stands at 6.8%. This is a generous level compared to the historical average of 5%, and a high for the year despite the strong appreciation of stock markets. A return to this historical average could lead to a revaluation of the European equity market of around 20%. In addition, European corporate earnings growth is on track. Earnings in 2022 are expected to be 20% above their pre-COVID crisis level. In addition, the earnings momentum remains supportive after the quarterly publications in Q3. Finally, the fourth pillar deals with the behavioral aspect. Long-term dynamics are bullish, as all international equity indices, with the exception of Asian markets, are well above their 200-day moving average. European indices have a key support corresponding to the historical highs of 2000, located less than 5% below the current levels, while seasonality is again favorable to equities. In conclusion, the environment is generally favorable for European equities. They remain strategically unavoidable in an asset allocation. The economic momentum remains at a good level, despite its recent slowdown. The central banks is flooding the financial system with liquidity, low interest rates justify a deep revaluation, and the market dynamics remains bullish even if the short-term dimension is more neutral. From a long-term perspective, the current correction, even though it may not be complete, appears to be an opportunity to increase exposure to European equities. Thank you, and see you next month for a new monthly video by Shaheen Capital.